Hey, good morning, everyone. Marty Mazura here, 11/11/2021, Thursday, with your morning note. Still have the bum hand, so still doing the video. Once again, I'll just start with the current market update. The Dow is down 73 points, or 20 basis points, 0.20%. The S&P 500 is up 0.25%. The NASDAQ composite is up 0.82%. Nice bounce from yesterday's drubbing in tech stocks. The Russell 2000 up 0.86% so far this morning. Our core portfolio, as I type, is up a very nice 0.71% so far this morning. Leaders are solar stocks, MP Materials, which is a rare earth miner, uranium miners, base metals miners, and Latin American stocks. Speaking of Latin American stocks, I mentioned liking emerging markets, adding to them a little bit here recently, and overnight news kind of supported that. The situation with China, there's a great deal of stress and worry over its property market, and rightfully so. In particular, Evergrande, which is I believe it's their largest property developer, with just a massive $300 billion worth of debt and late payments, fear that they're going to default, fear that there's going to be some contagion risk there. Well, overnight, they made some bond payments, and according to the Chinese state media, government's going to change policy to help developers access credit markets. So a big rally in those Chinese developer stocks overnight. And this morning, those that trade on the American depository receipts. Our emerging markets ETF is up 1.71% so far this morning by itself. The Brazilian stocks are rallying hard this morning, up 4.1%. Going forward, when you look at the resource demand relative to green energy pushes and that sort of thing, when you look at the problems we have with China, evolution of Chinese labor markets, we think Latin America is a real beneficiary of that. So we definitely like it right here longer term. In terms of commodities, which largely explains why our core portfolio is doing so well this morning. Gold is up 49 basis points, that's 0.49%. Silver is up almost 2%, 1.97%. Copper futures are up 2.25%. Oil futures are up 0.2%. The ag complex, as I like to call it, so this is the index that we track with an ETF, and it is up 0.75% so far this morning. So that's good. The bond market is closed today in observance of Veterans Day. All you veterans out there, sincerely, thank you so much for your service. But the equity markets are open for business today. Okay, so the chart in front of you, I'm just going to look at one or two charts and then let you go quickly. So the chart in front of you is one that I've shown clients often in review meetings, and we've featured it here on the blog a time or two. This is the bottom of the great financial crisis, March of '09, for the market's bottom. And the white line is the S&P 500. The blue is the Asia Pacific Index, MSCI's index. The purple is emerging markets. The green is the Eurozone. That's gold. The orange, and then the light blue is ag commodities. So U.S. stocks have had quite the run away from these five asset classes, or regions and asset classes, if you will. The bottom panel here is the dollar, and we show we've been in a fairly steady uptrend from about the point where U.S. stocks really began to break out. When we're talking stocks, we see valuations quite a bit more compelling. Outside the U.S., dividends are upwards of twice as good, so we can collect more income inside of portfolios by owning more foreign stocks. And we just think this relationship is going to come back down to earth going forward. And it's not just the reversion, it's the fundamental issues that are gripping the world and have made prisoners out of at least the U.S. central bank, and I would say the European central bank as well. But I want to be very clear that we're not wedded to anything that we're doing. It's all based on our assessment of current conditions. When I talk about this setup here and how I think this plays out going forward, essentially it's trying to be Wayne Gretzky And that's to skate to where we believe the puck is going or where it's going to be. And just to kind of give you a little more there. So what I did here is I showed you again the bottom of the great financial crisis, at least the bottom in the market, to current, although let me update that to 11/11, make it real current. It's not going to change any of this though. So now I'm going to go back to the bottom of the tech bubble burst, right up to about the top of the ensuing bull market. And as you'll see, and I know I've shown this before, with all except for ag commodities, the U.S. was a gross underperformer. So it was the opposite of that. And notice during that time, the dollar did what we expected to do on balance on a trend basis over the next several years, quite frankly. And you can see how, how that negatively correlated with foreign securities and also with gold right here as well. As for agricultural commodities, it's really been one of our better positions here of late. Again, weaker dollar feeds into an agricultural commodity thesis going forward, as does, crazy weather patterns right now, as does fertilizer costs and all the challenges that that growers are having in terms of, just putting food on everyone's table. Okay, lastly, I wanted to show you a similar chart, but just use U.S. stocks. And this separates the growth style from the value style. When we test our core portfolio now, and again, it's evolved quite notably since late 2019, in U.S. stocks, we're very much tilted to the value camp. How did those look from the bottom of the tech bubble to the top of the ensuing bull market? The value outperformed for most of the time. I'm going to throw in 1998, and then I'm going to take you to, let's just go out to 2004. I want to show you how value performed relative to growth when the tech bubble blew up. Right? You can see just an absolute disaster for growth stocks. Value, suffered, definitely had some drawdowns here. But man, oh man, did growth just come back down to earth, and then value started to outperform off of that. Again, folks, there's enough evidence that value could have a pretty good go of it relative to growth going forward, and certainly sufficient evidence that foreign, may have an edge on U.S. going forward. And that's not everybody's thesis; it just happens to be ours currently. Folks, I'll leave it there for another day, and of course, thank you as always for watching and listening, and I'll be back very soon. Take care. Bye-bye.